Look, I need to show you something that's happening right now in the gold market that most investors are completely missing. And if you own gold, or you've been thinking about buying gold, what I'm about to share with you could be the difference between protecting your wealth and watching it evaporate. Because here's what nobody's talking about. While everyone's focused on the price of gold hitting new highs, there's a much bigger story unfolding behind the scenes. And it's a story that involves central banks, massive institutional players, and a supply crisis that's been quietly building for years. Let me start with something that should terrify you. In the last 18 months, central banks around the world have purchased more gold than at any point since 1950. We're talking about 1,136 tons in 2022 alone. That's not a typo. Over 1,000 tons of physical gold, bought by the people who print money for a living. Now, why would the very institutions that control the printing presses be dumping their own currencies to buy gold? Think about that for a second. These aren't retail investors watching YouTube videos. These are the central bankers of China, Russia, India, Turkey, Poland. These are the people who have access to economic data that you and I won't see for months. They know something, and what they know is this. The dollar's dominance as the world's reserve currency is ending. Not might end, not could end, is ending. Right now. Let me paint you a picture of what's really happening. In 2000, the dollar made up 71% of global foreign exchange reserves. Today, it's down to 58%. And that decline is accelerating. Every single quarter, we see central banks diversifying away from dollars and into gold. The Chinese central bank has been buying gold for 17 consecutive months. 17 months. They're not doing that because they think the dollar is strong. But here's where it gets really interesting. While central banks are buying physical gold by the ton, something bizarre is happening in the paper gold market. The COMEX, which is the major exchange where gold futures are traded, has a ratio of paper gold to physical gold of about 100 to 1. That means for every ounce of actual physical gold that exists in their vaults, there are 100 paper claims on that same ounce. Think about that like a game of musical chairs. As long as everyone's happy holding paper promises, the music keeps playing. But the moment people start demanding physical delivery, the whole system collapses. And guess what? That's exactly what's starting to happen. In March of 2023, we saw something unprecedented. The COMEX had to change its delivery rules because too many people were standing for delivery. They were saying, "I don't want your paper promise, I want my gold." And the exchange didn't have enough physical metal to meet the demand, so what did they do? They changed the rules. They made it harder to take delivery. They increased the fees. They added restrictions. When the casino changes the rules mid-game, you know someone's about to lose big. And it's not going to be the house. Now, let me tell you about what happened in 1971 because history doesn't repeat, but it sure does rhyme. August 15th, 1971, President Nixon closes the gold window. He tells the world, "Sorry, you can't redeem your dollars for gold anymore." Why? Because foreign central banks, particularly France under Charles de Gaulle, had figured out that the US was printing way more dollars than it had gold to back them up. So they started demanding physical delivery. They sent actual ships to New York Harbor to pick up their gold. And Nixon had a choice. Either admit the dollar was overvalued and hand over the gold, or change the rules. He changed the rules. He closed the window. And what happened to gold after that? It went from $35 an ounce to $850 by 1980. That's a 2,400% increase in less than a decade. But here's what most people don't know about that period. In the 2 years before Nixon closed the gold window, if you were paying attention, you could see it coming. Foreign central banks were accelerating their gold purchases. The US gold reserves were declining rapidly. The smart money knew something was wrong. Sound familiar? Because that's exactly what's happening right now. The smart money, the central banks, the sovereign wealth funds, they're all moving into physical gold. And they're doing it quietly, but they're doing it aggressively. Let me give you another example. In 2011, gold hit $1,900 an ounce, and everyone said it was a bubble. Gold's too expensive, they said. It's going to crash. And you know what? It did pull back. It spent years consolidating. But here's what happened during that consolidation period. Central banks never stopped buying. While retail investors were selling, while the gold ETFs were seeing outflows, central banks were accumulating. China's official gold reserves in 2009 were 1,054 tons. Today, they claim to have 2,235 tons. But here's the thing. Nobody actually believes that number. Independent analysts estimate China's real gold holdings are somewhere between 4,000 and 6,000 tons. Why would they lie? Because if the world knew how much gold China was really accumulating, it would trigger a buying panic. The price would skyrocket before they finished accumulating. This is the game that's being played at the highest levels. And if you own gold, you need to understand the rules of this game, because they're about to change. Now, here's something else that should concern you. The cost of mining gold has been rising dramatically. In 2005, the all-in sustaining cost to mine an ounce of gold was around $600. Today, it's over $1,300 an ounce. That means at current prices around $2,600, the profit margin for miners has actually shrunk compared to historical norms. And what happens when profit margins shrink? Production declines. We're already seeing this. Global gold mine production peaked in 2018 at about 3,300 tons per year. Since then, it's been flat to declining. The easy gold has been mined. The high-grade deposits are depleted. What's left requires more energy, more capital, more time to extract. And with energy costs rising, with environmental regulations tightening, with geopolitical tensions making mining in certain regions impossible, the supply situation is only going to get worse. Meanwhile, demand is exploding. It's not just central banks, it's also industrial demand. Gold is used in electronics, in medical devices, in aerospace applications. As technology advances, as we build more sophisticated electronics, the industrial demand for gold increases. And unlike investment demand, which can fluctuate, industrial demand is steady and growing. But here's the real kicker. The BRICS nations, Brazil, Russia, India, China, South Africa, they're working on creating a new international currency. And while the details are still being worked out, every indication suggests this currency will be backed, at least partially, by gold. They're literally trying to create an alternative to the dollar-based system. And if they succeed, if they can convince even a fraction of international trade to settle in this new currency instead of dollars, the implications for gold are staggering. Imagine you're a country that's been forced to hold dollars because that's what you need to buy oil, to buy commodities, to engage in international trade. But now suddenly there's an alternative that's backed by real assets, by gold, by commodities. Why would you keep holding dollars? You wouldn't. You'd diversify. And the first thing you'd buy? Gold. This is why Saudi Arabia, after 50 years of the petrodollar agreement, is now accepting yuan for oil sales. This is why the UAE is setting up gold trading hubs. This is why countries across the Middle East, across Asia, across Africa are suddenly very interested in gold-backed trade settlement systems. The world is changing. The financial architecture that's been in place since World War II is being dismantled piece by piece. And gold is at the center of this transformation. Now, if you're sitting on retirement accounts, if you've got $100,000 or more in traditional IRAs or 401ks, you need to understand something. Those accounts are denominated in dollars. And if the dollar loses its reserve currency status, if inflation continues to erode purchasing power, your retirement savings could be devastated. I've put together a free guide on how gold IRAs work, how you can get physical gold into your retirement accounts without triggering tax penalties. It's in the description below, worth checking out if you're concerned about protecting your retirement from currency devaluation. But let me get back to what's happening right now, because the timeline on this is compressing. We're not talking about something that might happen in 10 or 20 years. We're talking about something that's happening right now, in real time. Look at what happened in March 2023 with the banking crisis. Silicon Valley Bank collapses. Signature Bank collapses. First Republic is teetering. And what did people do? They rushed to safety. And where did they go? Gold spiked. Bitcoin spiked. People were fleeing the traditional banking system. Now the Fed stepped in. They backstopped the banks. They prevented a full-scale panic. But here's what you need to understand. They did that by creating more money. They expanded their balance sheet again. They printed more dollars to save the system. And every time they do that, every time they choose inflation over deflation, they're making gold more valuable. Because gold is the ultimate inflation hedge. It's not just a hedge against consumer price inflation, the kind you see at the grocery store. It's a hedge against monetary inflation, the expansion of the money supply. And the money supply has been expanding at an unprecedented rate. Since 2020, the M2 money supply in the United States has increased by over 40%. 40% more dollars in circulation in just 4 years. Now the Fed will tell you that inflation is under control, that it's coming down. And sure, the rate of increase has slowed. But the money that was created? It's still out there. It's still in the system, and it's still eroding the purchasing power of every dollar you hold. Gold, on the other hand, can't be printed. There's a finite amount of it, and the rate at which new gold is being mined is declining. That's the fundamental equation. Increasing demand, decreasing supply. And we all know what happens when that equation plays out. But here's where most gold investors make a critical mistake. They think of gold as an investment, something that's supposed to go up in value so they can sell it for a profit. That's not what gold is. Gold is insurance. It's wealth preservation. It's the asset you hold so that when everything else is falling apart, you still have purchasing power. Let me tell you a story about a man named John Exter. He was a vice president at the Federal Reserve Bank of New York in the 1950s. He created something called Exter's Pyramid, which is a hierarchy of assets based on their risk and liquidity. At the very top of the pyramid, the riskiest, most illiquid assets, you have things like derivatives, structured products, junk bonds. As you move down the pyramid, you get to stocks, then corporate bonds, then government bonds, then cash, and at the very bottom, the foundation of the entire pyramid, the most liquid, least risky asset, gold. Exter's insight was that in times of crisis, capital flows down the pyramid. People sell their risky assets and move into safer assets. And in a real crisis, a systemic crisis, everything flows to the bottom. Everything flows to gold. We saw this in 2008. When Lehman Brothers collapsed, when the entire financial system was on the brink, gold was one of the few assets that held its value. While stocks were crashing, while real estate was imploding, while even corporate bonds were selling off, gold was the safe haven. And here's the thing. 2008 was a liquidity crisis. It was a crisis of confidence in the banking system. But it wasn't a currency crisis. The dollar actually strengthened during 2008 because the world still trusted the US financial system more than any alternative. But what happens when the next crisis is a currency crisis? What happens when the world loses confidence, not just in the banks, but in the dollar itself? Where does capital flow then? There's only one answer: gold. And the signs of a currency crisis are everywhere. The U.S. national debt is over $34 trillion. That's trillion with a T. The interest payments on that debt are now over $1 trillion per year. We're paying more in interest than we spend on defense. And the debt is growing faster than the economy. That's unsustainable. Everyone knows it's unsustainable. But nobody wants to be the one to say it out loud. So, what's the solution? There are only three options. Option 1, raise taxes dramatically and cut spending dramatically to pay down the debt. Politically impossible. Option 2, default on the debt. Economic suicide. Option 3, inflate the debt away. Print more money, devalue the currency, make the debt worth less in real terms. That's the path we're on. That's the path every major economy is on. And when you inflate the debt away, when you devalue the currency, the people who suffer are the savers, the retirees, the people who did everything right, who saved their money, who planned for the future. Their purchasing power gets destroyed, unless they own gold. Let me give you a specific example. In 1971, when Nixon closed the gold window, the average American worker earned about $6,500 per year. A new house cost about $25,000. A new car cost about $3,500. Today, the average worker earns about $60,000 per year. A new house costs about $400,000. A new car costs about $48,000. So, in dollar terms, everything got more expensive. Your salary went up, but the cost of living went up even more. You're working harder to afford less. That's inflation. That's currency devaluation. But here's the interesting part. In 1971, gold was $35 an ounce. Today, it's around $2,600 an ounce. If you had taken your $25,000 house down payment in 1971 and bought gold instead, you'd have 714 ounces of gold. Today, those 714 ounces would be worth $1.86 million. You could buy 4 houses with that. That's the power of gold as a wealth preservation tool. It's not that gold went up in value. It's that the dollar went down in value, and gold maintained its purchasing power. Now, I'm not saying you should sell your house and buy gold. I'm saying you need to understand what's happening to your currency, to your purchasing power, and you need to take steps to protect yourself. And here's the urgency. The window for doing this at reasonable prices is closing. When the general public figures out what the central banks already know, when the panic buying starts, the premiums on physical gold are going to explode. We've already seen this in certain markets. In India, during times of high demand, the premium on physical gold over the spot price can reach 20% or more. In China, during the pandemic, premiums hit 30%. Imagine trying to buy gold when everyone else is trying to buy gold at the same time. The dealers will be sold out. The premiums will be astronomical. The delivery times will be measured in months, not days. And if you're trying to get gold into a retirement account, the process becomes even more complicated when everyone's trying to do it simultaneously. This is why you act now, when the market is relatively calm, when supply is available, when premiums are reasonable. You don't wait for the crisis to happen. You prepare before the crisis. And make no mistake, a crisis is coming. It might be a banking crisis. It might be a sovereign debt crisis. It might be a geopolitical crisis that disrupts global trade. It might be a combination of all three. But something is going to break. The system is too leveraged, too fragile, too dependent on continuous money printing to survive indefinitely. The central banks know this. That's why they're buying gold. The sovereign wealth funds know this. That's why they're buying gold. The ultra-wealthy know this. That's why they're buying gold. The question is, do you know this? And more importantly, are you going to do something about it? Because here's the reality. Gold isn't going to make you rich overnight. It's not a get-rich-quick scheme. It's not going to double in a month. What gold does is protect you from getting poor. It preserves your wealth when everything else is losing value. It gives you purchasing power when currencies are collapsing. It provides stability when markets are in chaos. And in the world we're heading into, that stability is going to be priceless. Look at what's happening in countries that have already experienced currency crises. In Venezuela, people who owned gold survived. People who held bolivars lost everything. In Zimbabwe, people who owned gold maintained their wealth. People who held Zimbabwe dollars became millionaires who couldn't afford bread. In Argentina, in Turkey, in Lebanon, the story is the same. When the currency collapses, gold is the lifeboat. And the United States is not immune to this. The dollar's reserve currency status has protected us for decades, allowed us to run massive deficits, to print unlimited money, to export our inflation to the rest of the world. But that protection is ending. The world is moving away from the dollar. And when that process accelerates, when the dollar loses its privileged position, Americans are going to experience what the rest of the world has already experienced: currency devaluation, inflation, loss of purchasing power. The only question is, will you be prepared? This is your urgent update. This is what you need to know if you own gold, or if you're thinking about buying gold. The fundamentals have never been stronger. The supply situation has never been tighter. The geopolitical environment has never been more favorable for gold. And the risks to the dollar have never been higher. The central banks are buying. The smart money is buying. The question is, what are you going to do? Because this isn't about making money. This is about protecting what you've already earned. This is about ensuring that your life savings, your retirement, your family's financial security isn't destroyed by forces beyond your control. This is about taking responsibility for your financial future in a world where the rules are changing. Don't ignore this update. Don't assume everything will be fine. Don't trust that the government will protect you, or that the Fed will save the day, or that the dollar will remain strong forever. History shows us that currencies fail, empires decline, financial systems collapse. And when they do, the people who prepared, the people who owned real assets, the people who owned gold, they're the ones who survive and thrive. The time to act is now, not tomorrow, not next month, not when the crisis is already here. Now, while you still can, while supply is available, while the system is still functioning. This is your alert. This is your urgent update. What you do with this information is up to you. But don't say you weren't warned.